All right, so some of us already have started. You've taken a class on trading psychology before, and then you probably have, or you probably haven't before. Okay. Now this session is so important that I was talking with someone this afternoon, right? This afternoon, and the person was telling me how that they are great traders. They're taking all kinds of trainings in the forex market. They understand, in fact, a lot of the things I was talking about, they understood it. They know Fibonacci, they know support and resistance. They know all kinds of strategies in the market, right? But the problem was they keep losing money. The person was telling me he just blew several accounts again yesterday, right? And then as I spoke with this person, I started telling him that, hey, from what I'm seeing as you're talking to me, I'm seeing psychological issues, right? He said he wanted to even, he was now thinking that he probably has village problem, right? I told him something. I said, I've always told people that when you have issues with psychology, when you have psychology issues in trading, it usually looks as though some people are after you. Says village people involved, right? There's village people involved. That's literally how it is, because it's more like a program running in your mind, a program running at the back of your mind. It's more like this program is running at the back of your mind and you literally have no control over it. Okay, so we're discussing, I was telling him, this is how you're going to take care of this. This is how we're going to take care of this. This is how we're going to take care of this. And then, right, so that's the way psychology is. So psychology is not something that you joke with in trading. A lot of times, many traders feel like, okay, I just need to grab this strategy that will make me money. I need to get this strategy that will make me money. I need to understand analysis. I need to know fundamental analysis. I need to know technical analysis. All that is great. All that is great. Really, you can't be consistently profitable in the market except you know technical analysis, fundamental analysis, and all of that. But that's very important. Even sentiment analysis too. All of that is very important. But the truth is, when you know all of that, and then psychology, in the area of psychology, you are still lacking, then you find out that you hear stories, a lot of bad stories that many people have heard about Forex is all due to psychology. Someone was saying something today, and he was talking about how somebody blew $100,000 account to 3,000. He said he literally reduced a live account, not a demo account, a live $100,000 account to 3,000. So someone's like, oh, is this how Forex is? I'm like, that situation has absolutely nothing to do with Forex. That person could have as well gone to the casino and did that same thing. In fact, he probably won't, he doesn't need to trade Forex to lose that. His problem is psychology, totally. He doesn't need to trade. Even if he didn't trade, he would have lost that money elsewhere. There's a program running in his mind that he needs to take care of, right? So that's the reason psychology is so powerful. Psychology, it's been said that psychology is more than 90% of trading. And a lot of people who have even heard about psychology, have even read psychology books, trading psychology books, and still haven't gotten it, right? The reason why they've not gotten it is because there are certain, when you want to deal with a major issue that is not physical, that is basically mental, when you want to deal with it, the major way you deal with it is through creating a framework for dealing with it, right? It's just like you are used to doing a particular thing. You are used to responding a particular way. And now you want to completely transform yourself. You want to completely change yourself. It's more like you're trying to change the way you think and the way your habits have been formed, habits that you formed for years. You've taken a decade to form a certain habit and you want to break it overnight, right? And you just think you're going to break it just because you think you want to break it. It doesn't work that way. There has to be a framework for you to go through it, right? That's why you see many times when people want to make significant changes, they usually go to a coach, get a coach, right? A coach can help you with that kind of a thing. When you want to make a significant change, especially it has to do with mental, it has to do with habits, it has to do with your personality, you know, you usually will need help from some kind of an expert, right? That's it. Even when it comes to weight loss, it comes to anything that you built up as you grow, as you've been growing, as you've been operating, and you want to change it, it doesn't change overnight. It won't change overnight. And that's the reason, that's also the thing why trading psychology messes with people, and they don't even know it's trading psychology messing with them, right? So it's so important. I'm kind of passionate about trading psychology because I have seen the kind of things, because the way it deals with traders, the way it messes traders up, the way it makes you fail, the way it makes you, it makes it difficult for you to execute the things you know, right? You know something, you know I'm supposed to do this, and you know I'm not supposed to do this. You in fact do it, and then you wonder, why did I do it, right? So it's more like you're in a situation where you are out of control. So how do you deal with this? So this is what trading psychology is all about. It's not something that you, it's more like when you're preparing for battle, right? When you're preparing for war, you're preparing for a battle, you can't just go there and say, you know what, I'm well armored. I'm well armored. Because I'm well armored, I am going to win. I am going to go there and I'm going to kill everybody. I am going to win the battle. You don't win the battle because you're well armored, because the truth is the guys you're meeting the battlefield are also as well armored as you, or probably more armored than you, right? Their weapons are probably more high-tech than yours. So, right, the most important, the way you're going to win that fight is through a strategy, is through a plan, right? So that's the same thing when it comes to trading psychology, because trading psychology, I will tell you guys, is number one thing that can mess with your trading more than anything else. Okay, so let's get into it. I wrote down a few things on my chart here that I'd like to go through. So first and foremost is, I said trading psychology refers to the emotions, behaviors, and thought processes that influences a trader's decision-making and performance in the financial markets. Now, this class is something that we're going to be revisiting once in a while, right? We're going to be revisiting classes on psychology, because many times psychology is not something that you just go through at once and you're like, oh, I got it, I have it sorted. No, it's something that you keep working on. You know, it's like a behavioral change. You don't change behavior in one day. If every day of your life over the past 90 days or maybe 3 months, 6 months, you always woke up every single day by 7 a.m., and then something happened, and you are trying to now wake up every single day by 3:30 a.m. You're trying to wake up every single day at 3:30 a.m. You're not going to find it easy. You're absolutely not going to find it easy, right? That's just the way it is. 1 minute, guys. Someone is messaging me. Okay, so now you are not going to overcome it all at once. All right, it's like work in progress. You can't just wake up now and say, okay, every day I've been waking up 7 a.m. every single day. Now I'm going to start waking up 3:30. You may do it for a few days before you know the habits you built up for 6 months, for 1 year, for 2 years will kick in and start to mess with you and start to fight with you, right? Before you know, you wake up and then you go wherever you're going and you start getting sleepy there. It will just be clear to someone else who hasn't known you before that something is wrong. Yeah, right? That's the way trading psychology is. So, but over time, by the time you learn to do that for 1 month, 2 months, 3 months, and all that, you maintain it, you find a mechanism, you find a process, you find a process to maintain that, then you realize that you are able to begin to achieve the new goal that you have now. You'll be able to, then it will not, once you start to do it, then at that point, it's not messing with you anymore, because you're basically replacing an old habit with a new one. So that's the reason why it's important to come and revisit this trading psychology once in a while. So while you practice what's going on with my trading, how is this affecting my trading, right? So that's what I do. I make sure I'm looking at what I'm doing. I'm looking at my trading. I'm like, hey, right? So how am I following the rules that I'm supposed to follow and all of that? Because the truth is you're trying to change yourself and it's not an easy task. So emotions such as fear, greed, hope can lead to irrational trading decisions and losses, right? So now you enter the particular trade. You enter the particular trade and the trade went in your favor. You were making money. You were like, oh, great, I'm making money. Now you are saying to yourself, hey, this trade needs to get to this particular area before I take profits. Okay, this trade needs to get to this particular area before I take profits. And then you know by the way the market functions, or by the way a particular instrument you are trading, by the way it works, you are not meant to be in the market at that time. For example, there's an instrument I trade that I usually don't like trading during the Asian session. I don't like trading it during the Asian session, right? Because there is a way the instrument plays. There's a way it functions and plays out during the Asian session as compared to during the New York and during the London and New York sessions. So usually, if I enter a trade on that particular instrument and I leave it overnight, something that I did not plan for is likely to happen. Something I didn't plan for is likely to happen. Right? So I already know that. So if I know that, why would I enter a trade and keep it running overnight? When I do that, there's likely going to be a challenge there. The reason I would do that is because there is a particular trade I feel like this setup is so amazing. This setup is so amazing, I just can't afford to miss it. If it happens overnight, how am I going to miss this trade? Right? If it happens overnight, how am I going to miss this trade? If it happens overnight, how am I going to miss this trade? Right? So this is what that's the only thing that can make me take that trade. Right? So now the question is, am I going to go ahead and take that trade, or am I going to go ahead and not trade it, knowing what I know? Right? So you see how you can sometimes you can be like, oh no, and let me just do it this once. I think this trade that is coming is going to really be it's going to be wonderful. It's going to make me a lot of money. I will do it just this once. I won't do it next time. That's what you call greed. That's what you call greed. It starts to come in, and then when it goes against you, it does opposite of what you expected to do, and it puts you in a negative. You start telling yourself, I knew I shouldn't have done this thing. I knew I shouldn't have done this thing. But what you're not understanding in that moment, is that there is something underneath your mind that's making you take the decisions that you're taking. There's something in your mind that's making you take the decision that you're taking. So except you address that situation, except you address that thing that made you take that decision, you are still in that loop. Even if you acknowledge it, even if the market goes against you tomorrow and you're like, whoa, I shouldn't have done this, I shouldn't have done this. That's not the answer. You will do it again. And if you're in this situation, you understand what I'm saying. You will do it again. You will regret it. You will do it again. You will regret it and do it again. So why are you doing it? Why does it continue like that? Because there are certain emotional connections, as it were, in your mind that you have not addressed. You have not created a framework to help you solve it, right? It's just like that situation where I talked about sleep. You always woke up 7:30. Now you want to wake up 3:30, right? This is what you've done all your life. Now you want to change it overnight. You could wake up the first day or maybe the second day, you do it 2-3 days, and the next day, the third, fourth day, you wake up again 7:30 and you are beating up yourself. Oh, I should have woken up early. Oh, I should have done this. I should have done that, right? But the truth is that going to stop? Is that going to solve the problem? Is that going to stop you from falling into that trap again tomorrow? No. The only thing that can force you, that can stop you from falling into that trap tomorrow is by having a mechanism, a process, a way of actually helping yourself achieve this goal that you have set for yourself. What am I going to do? What are the triggers What triggers do I have that keeps me sleeping like this? What do I replace those triggers with? All right. So is it that at a certain time there's something that usually makes me? It could be that, oh, when I have AC on or when I have fan on, I tend to sleep longer. So how am I going to do that? So what I'm just saying generally is that you have a mechanism that you're going to change. You're going to have to change some things in order to create a new outcome. Otherwise, it won't happen. So when it comes to psychology, guys, we don't talk anything about strategy and all that. That's why some people tend to be like, oh, no. They're not very interested in psychology. But then the psychology is the issue that they're having. The psychology is the issue that they're having. But because we're not discussing how much money you can make, strategy here and there, they seem to not be interested, right? So that's the way it is. So you don't become that person. Don't be that person who doesn't take psychology as very important, because psychology can change the game. Just changing your psychology, achieving a new goal psychologically with your trading can totally change your trading. Just turn it up, turn it 360 degrees and change everything about you and about your trading, about the results that you're getting in your trading, right? So fear, how does fear come about? Fear comes about by you having a negative outcome. So now you're not meant to enter this trade yet, and then you enter it. Or maybe you enter this trade, you have $100 in your account, and then you do your analysis and you say, man, I'm so sure this trade is going to go my way, and you use 0.1 or 0.5 or enter that trade, and you know it's not the right thing for you to do. But because you are thinking of how much you're going to make before how much you are going to risk, you do that. That's why in trading, we always tell you during our risk and money management class, we always tell you how that you need to think risk first. Think risk first before reward. Risk first before reward, because guess what? The risk is guaranteed, the reward is not. Risk is guaranteed, reward is not. So, but then we have a mechanism for grabbing the rewards. But then we think in terms of risk first. When we think in terms of risk first, then we are able to navigate the market and then go for the reward. And we are now able to achieve the result, right? So you enter a trade and you're looking at a stop loss of 50 pips, right? Now, if that goes against you, it could hit your stop loss and you are probably down 3% on your account. But you've already programmed that trade that if this trade goes against me, it goes in my favor, I'm going to make 100 pips. Right? So that's what you need. That's what you need to do. You need to be able to find a mechanism to grab the reward. But then you think in terms of risk, because the risk is what's guaranteed. Because if the market goes against you, it will hit your stop loss. So that's guaranteed. But if your trade goes in your favor, it's not guaranteed that it's going to hit your take profits. But it will. In many cases, it will, but that's not the guarantee. So you have to think, because, and even if that trade is guaranteed, think about it, guys. Even if that trade is guaranteed, when you make profit, your account grows, right? Nothing bad happens. But when you don't make profit and your trade hits stop loss, your money is depreciating. So your capital, so you are thinking, when we say think of risk first, you are thinking capital protection first. That's actually what you're doing. Okay, so in this case now, watch this. In this case now, we're talking about fear. In this case, you enter a trade and then you use the huge loss size on the small account. And then the thing starts going in your favor or it goes against you. And before your very eyes, you see your money go, your $100 goes, like you lose it. And then the reason why you are not able to close it, you're like, okay, it goes to $50 negative, it goes to $30 negative. You're like, okay, to reverse, $50, $70. Like that, it comes to a point where you're thinking, see, even if I close it at this time, what's $30 remaining? What's the $20 remaining? You lose that money. So guess what happens when you lose like that? You become fearful. Now, when you become fearful, here are some outcomes that will happen when you are fearful. The outcome that will happen now is that your fear will now be projected into the future. Your fear will not be projected into the future. So what happens is that you have your strategy, right? And you're thinking, this is how I'm going to trade. I'm going to, when market goes to this point, I'm going to take a buy. When market gets to this point, I'm going to take a sell. But what happens at that point is that you find that you freeze. you will find that you freeze. You are ready to enter the market. Market has done exactly what you expect it to do. Now, at the point where you are meant to trigger the trade, buy or sell, you freeze. You cannot take the trade again. Why? Because you are still afraid about what happened. And the outcome that happened that causes this fear now was caused by you. The outcome that happened that not put you in a state of fear was caused by you. Right? But if you had maintained your proper risk management, you will not have that fear come up in at all. So you see how the actions we take in the market can trigger emotions. Emotions can trigger actions. Actions can trigger emotions. So the first one is you trigger you're thinking of what I'm going to get. You're thinking of what I'm going to get. That's great first. Now you take a trade that you're not supposed to take, or you take loss side you're not supposed to take, and you lose money. Now the emotion of fear has taken over you. So all of these things, there has to be a way for taking care of them. We will talk about that. Then hope can lead to irrational trading decision. Hope is when a trade is going against you and you're thinking it's going to reverse. Have you heard of that? It will reverse. In trading, it will reverse. It will reverse. The trade is going against you. You are saying it will reverse. How are you sure? How are you sure? That's the reason why you need a stop loss. And when you put a stop loss, you leave it there, right? So you don't say it will reverse because you are not the market. It's just like when you wake up in the morning, you need to be at work and rain is falling heavily, and you sit down at home and you say it will stop. Who told you it will stop? Nobody. You need to find another way. Find something you can wear or an umbrella or something and get out. It may not stop. It's possible it could stop, but it may not stop. What if it doesn't stop? What are you going to do? So you make another plan. So you're not thinking of in this situation, you make the plan using a stop loss. Okay, so some common psychological biases for everybody. Also, just before I move on from this, anybody who trades without using a stop loss has a psychological problem. Anybody, if you are there now, you are a trader. If you are trading without using a stop loss, I can tell you that you have a psychological issue that you have not resolved. There's a psychological issue that you are yet to resolve. That's why you are not using stop loss. And you are thinking that not using stop loss will actually stop you from losing trades. Not using the stop loss will stop you from losing trades. That's the way you're thinking. That's why you're not using the stop loss. So just know. And so what you have to think about is this. When you have these psychology issues, you are usually not aware. So many times it's when someone has pointed out, someone who knows better, has pointed it out to you, that you now realize that this action you've been taking is actually as a result of a psychological issue in your mind concerning trading, just like what I just said now. If you are someone that trades without using a stop loss, you have a psychological issue. That's just it. There's a reason why you're not using it. And the reason why you're not using it, the reason why you're not using that stop loss is because you are actually afraid of losing money. And you think that not using a stop loss is what's going to prevent you from losing money. That's actually why you're not using it. And usually what happens is that what you are afraid of is likely going to happen. Okay, so let's move on. Some common psychological biases that traders may exhibit include overconfidence. This was something that the person I was talking with this afternoon that I earlier said was talking about. He says sometimes he feels overconfident. You know, he knows this thing, he feels like he knows the market very well, and then he just goes overconfident. Now, in what way does overconfidence show up? You start to increase lot size. You stop calculating risk. You stop thinking in terms of risk. You're only thinking of how much you are going to make. So every time you make a losing trade, it's like a surprise. It comes like a surprise to you. When market doesn't do what you expect, it's a surprise to you. Because as far as you're concerned, the market is there to respect all you want, respect you and do exactly what you want. So if the market doesn't do what you want, it's like a shock to you. It's like a surprise to you, and you're like, why? Excuse me. It's like, why? What's happening? Why is the market doing this to me? And usually you find out that what's happening is that you start to exhibit certain emotions of pain. The emotions of pain, the emotions of the emotions of disappointment. despondency, disappointment. It looks as if somebody broke your heart, or somebody just slapped you, somebody just hurt you. Those are the emotions you start to feel when you trade based on overconfidence. You see, when you trade based on overconfidence. So the market goes against you now and you are angry. Why would the market go against me? More like, how dare he? How dare this market go against me? Or upon everything I know, how dare you confirm that I'm wrong? You see, because you have to always make plans for being wrong in the market. You always have to make plans for being wrong. What if I'm wrong? How far can this thing go against me? That's the purpose for a stop loss. That's why we go back again to a stop loss. You see, we don't use stop losses because we want to lose. We don't calculate risk first before we enter a trade because we plan to lose. No, that's not the reason why we think of risk first. It's not because we want to lose. It's because we want to protect our capital. And because we know that we don't have a crystal ball, we don't know the future. So because we don't have a crystal ball and we don't know the future, we know that in as much as we have done all our analysis, we've done what we are supposed to do. We also know that in certain cases, in 10 trades, there might be 2 or 3 trades that don't go our way. We are fine with that. We can live with that. You see now, we can live with that. That's the reason why we don't really want to, that's why we think risk first, so that in those small cases in those few cases, where things don't go our way, we can still protect our capital and hold the money to go into future trades. Okay? Then confirmation bias. Confirmation bias comes in a situation where you have so many things on your chart. Sometimes you might look at some people's chart. You have Fibonacci, you have Elliott wave, you have pivots, you have all kinds of things on their charts. All kinds of things. The chart looks like a very busy place, very, very busy place. So now one indicator is saying buy, the other one is saying sell. They are not sure which one they should do anymore. That's what you call confirmation bias. You see? So you are wondering, should I buy now? Should I sell? One is saying buy, the other one is saying sell. The other one is saying two are saying buy, the other two are saying sell. That leads to confusion. Confusion. Now, in certain cases, actually confirmation is a good thing for you to be able to know what you are likely to do by 1 or 2 factors in the market, confirmations in the market. Maybe a structure was broken, support structure was broken, so you are expecting to sell, right? So maybe as you're doing that, you also have a trend line that is telling you to sell. That's a good one. Confirmations are good, but when you have too many, it starts to confuse you rather than enhance your trading. You see? So that's what you want to be able to pick 1 or 2 things to help your trading rather than confuse your trading. And some people that use so many different things, they think that they will be profitable just because they have so many things on their charts. And when you look at them, at the end of the day, you ask them what's going on. They are not doing well, even though they have so many different things on their charts. And then you see somebody else who has absolutely nothing on his chart. He's just looking at price action, and he's the one making all the money. And the disposition effect, the tendency to hold on to losing positions for too long. So you see that now, it's called a disposition effect. The tendency to hold on to a losing trade for too long. So you enter a trade and the trade is going against you by 10 pips. You say, no, it will reverse. You start by it will reverse. Then it goes to 20 pips, negative, 30 pips, negative. Your 30% of your money is gone. Let's say you're trading $100, 30% of your money is gone, 40% is gone. Then at that time you switch. Now you're no longer thinking it will reverse. You're thinking, no, I can't lose this much. I can't lose this much. It has to reverse. It will reverse to, it has to reverse. Then it goes to -50. Then it goes to -60. Now you are thinking, if I close it, I've lost $60. I've lost 60% of my money. How am I going to recover it? You are thinking so many things. How am I going to get it back to 100? How am I going to make profit on 100? You've not even protected what you have, and you're thinking of how you're going to make more money. So what happens is there are people that will just be like, you know what, let me take my eyes away. Let me not be watching, so that when I'm not watching, I don't care what happens. Let me not watch so that I don't feel bad. Let the market do what it will do. And then the market continues to take your money. It goes to -70, -80 until the account blows and the person comes there, his money is gone. That's called the disposition effect. You see? It's important for traders to be aware of their psychological biases and work to overcome them through self-reflection and education. So this self-reflection you're seeing here, guys, if you are a trader that has psychology, in fact, whether you have psychology, whether you think you have a psychology issue or not, this self-reflection is very, very key. This self-reflection is one of the reasons why we talk about journal. We'll have another class, we'll do that in another class. Self-reflection is the reason why we talk about journaling, taking note of what went wrong. If a trade went wrong, how did it go wrong? Why did it go wrong? What went wrong actually? What happened? Because the truth is that at a time where maybe a trade, even when you make a lot of profit on a trade, there's a tendency to not think about why did I make that money? You'll be like, oh yes, my thing is working. That's why I made the money. And then the thing is also that when you now make a losing trade, you are no longer thinking, you're not going to sit down and say, why did I lose? There's an advice someone gave. I was in training some years ago, and the person said, if he loses a trade, he will not take another trade until he has discovered and assessed this particular trader lost. He will assess it and make sure that he knows why this trade lost before he moves on to the next. And that got him to a point where he became so good with the market and with himself. Because it's not just about mastering the market, it's about mastering yourself. Because when you talk about self-reflection, it's not the market, it's yourself. You see? So this is so important. This is way, way important. So when you sit down, you take your journal, you say, okay, this is why this trade worked. This is why this trade did not work. Then when you do that, you'll be able to begin to see patterns. Sometimes you might even think I have a problem. I don't really know this market because you've made several losses. So you start to, your confidence is low. You start thinking, I don't think I'm as good as I don't think I'm really good with this trading. But when you sit down sit down with your journal, and then you start to see patterns, you'll be like, okay, now I broke this rule, I broke this rule, I broke this rule. Okay, this is not as if I'm not good. Or maybe you even have some winning trades. Okay, and then you took note of all of them. Okay, maybe I'm really not that bad. Maybe this is what I need to change. This is what I need to. But if you don't do that, you will just take a blanket concept, a blanket idea that, oh, I am so good or I am so bad. You see? Now you could even go, for the part of it where you're thinking I'm so good, overconfidence, you might do something you're not supposed to do and it still work for you. And now you make that a rule. You say, okay, work for me the other day, I'll do it again. And then the next day you try to do it, it doesn't work for you at that time. Meanwhile, you were not supposed to even do that at all in your trading. So traders can use techniques such as meditation, mindfulness, cognitive behavior therapy to improve their emotional regulation and decision making. So basically, what this is saying is that you need to have a mechanism generally. We've talked about, in the first class we talked about how to develop a trading plan. That's the first class we had this year. Now, the reason for a trading plan is so that you can document every single step you take in a day when it comes to trading. So what do I do first when I wake up? If trading is not the only thing you do, most likely trading is not the only thing you do, right? So what approach do I give trading in a day? When do I usually come into the market? What do I do before I come into the market? What do I do before I come into the market? All of that is so important. And this is where you might decide that you want to have a quiet time of meditation to calm your mind down, because sometimes you wake up and your mind is very busy. You wake up and your mind is already thinking of so many different things you should be doing, you are not doing, and all of that. But when you are able to calm your mind down, this meditation and mindfulness you're seeing here is something that works for everybody. It works for everything you're doing, whether you're trading or you're running your business or you're a pastor and all of that. It's been proven that these techniques, they actually have an effect on you. When you are able to sit down in the morning and you're able to calm your mind for a little bit of time, it could be 5 minutes, it could be 10 minutes, and you just keep quiet and calm your mind, there's a way there's a way it helps your mind and your brain cells to organize, and then it affects your trading or whatever else you're doing in the day very positively, right? I know there are many people who don't like motivational speakers. So, is a motivational speaker? Oh yes, there are many things about motivation, right? that may not work for many people, or that may not even be necessary like that, right? But then there are some things that are useful. There are some things that are useful. So when they are useful, you pick them and you use them, irrespective of what or who is talking about it and whatever they mean. You pick them and you use them. And if you also use them, you think they are not working for you, you put it aside. It's not as if there is a way, there's the way to do what you need to do in a day, or there is the way to create, just like when you create a trading plan. There is no perfect trading plan. There's nothing like that. What is there is just one that works for you, one that works for you, right? For example, if you live in the United States and someone else lives in where now? Someone else lives in Thailand. The first of all, the time when you wake up are very different, right? And if you are a trader, you are still going to be trading the exact same markets. One person is up, the other one is asleep. Yet you're still trading the same market. So when you create your trading plan, you have to factor in what markets am I going to be trading. If I'm going to be trading, if I'm in the US, for example, and I want to be trading London session, that means I wake up 2 a.m., 1 a.m. at night. That's the way it is. If that's something you're willing to do, then that becomes a part of your plan. If that's not something you're willing to do, then of course that won't be a part of your plan. But somebody who lives in Nigeria, for example, will have a different plan, because when the London session is opening, that's when we wake up. That's when it's morning. That's when it's 8 a.m. or 9 a.m. So you may not necessarily be like, okay, you may not have the same elements in your trading plan as somebody who lives in the US. You see? So those are the things. That's why it's important what exactly it is that works for you. What's important is you actually sit down and create this plan, right? So if you've not had the chance of going through that class where we talked about trading plan, is very, very important. It plays into this thing we're talking about too, because the only way you can create a new psychology, only way you can create a new psychology and really take a hold of your psychology is by having a plan. A plan. So we talked about a framework. That framework is basically a plan. What am I going to do when this happens? What will I 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 do when this happens? If I enter a trade and the trade loses, what do I do next? Do I enter the next trade? Do I take a walk? Do I sit down, analyze the trade? Do I document the trade? All of those things are very, very important. And if you do not prepare those things ahead of time, it's more like entering a battle without a plan. You are entering a battle because that's what you're doing every day as you enter the marketplace, whether you are trading online or you go into the market where you are selling products and services. You are coming into the marketplace every day. You have to have a strategy. You have to have a plan as to how am I going to win in this market every day? Because you're not the only player. There are several players there. Everybody came to win. Everybody came to play and to win. Nobody came to lose. So how are you going to beat the other person? How are you going to be the one to take more market share than the other person? How are you going to be the one to make more profit than the other person? How are you going to take more pips than the other person? There has to be a plan. So risk management, you see now, developing a trading plan with clear rules and objectives can help traders stick to their trading plan, their strategy, and avoid making impulsive decisions based on emotions. Did you see this? Developing a trading plan with clear rules and objectives can help traders stick to their strategy and avoid making impulsive decisions based on emotion. So the class I did in January on how to develop a trading plan, I'll probably share that class again in the group tomorrow. I'll find that video, bring it out and share it in the group tomorrow, so that for those who just joined the group or who've joined the group since that time, you'll be able to go back and watch that video. I will even do another class on that. I'll do another class on that. But in the meantime, you can go back to that class and then really begin to understand, because the only way you can take a hold of psychology is by developing a plan, is by this plan, this statement here right now. Developing a trading plan with clear rules and objectives can help traders stick to their strategy and avoid making impulsive decisions based on emotion. This is the answer to the issue of psychology right here. This is the answer to the issue of psychology. All right. This is the issue. Risk management is a crucial component of successful trading psychology, as it helps traders control their emotions. All of this risk management is still part of developing a trading plan. In your trading plan, there's going to be your risk management framework. What that means is that if you have $1,000 in your account to trade, you're going to ask yourself, how much do I risk per trade? What's my risk per trade? That's going to be part of your trading plan. What do I risk per trade? That's going to be part of your trading plan. So until that, if that's not part of your trading plan, then your trading plan is not complete. So you see why I say developing a trading plan is actually how you take hold of psychology. When you see that, you develop that trading plan, and then that trading plan, you stick with it. And then the next thing is you journal your trades. You take notes. You'll be like, okay, I made this plan, right? Did I fulfill this plan? That's what journaling is. Did I do exactly what I thought I would do? Did I do it the way I should do it? According to my plan. My plan says this. So at the end of the day, did I do that? That's what that's a contrast between a trading plan and a journal. It's more like the journal is the accountability part of the plan. The journal is the accountability part of a plan. This is what I determined to do. Did I do it? That's the journal, right? So surrounding yourself also with a community of people who you talk to. Hey, what's up? What are you doing? What are you doing? What are you doing? It's very, very important. Finally, maintaining a healthy work-life balance and all of that, right? So that's very important. When you are rested, if you wake up in the morning and you did not sleep at night and you feel agitated and your mind is not calm, you will find out that will play into how you are analyzing the markets, how you analyze the market. You see, you might be seeing things that are not there. You might be seeing things you shouldn't be seeing. You might be seeing buy inside sell. You might know that, okay, I'm supposed to start from higher time frame and then come down to lower time frame. And then on that particular day, you don't do that. You just come into the market and the first trade you see, you enter for a buy, only for you to realize that it was a pullback for a sell. By the time you look, the pullback of a sell has happened and your trade is in huge negative. But at the time you entered, it looked like a buy because you're not calm, you're not settled. Right? That's the reason why you need to calm down and be settled. So a plan is the most important thing in this whole thing we talked about right now. Developing a plan, right?